$5,000. Gold just crossed that number for the first time in history, and then held it through an active war, rising Treasury yields, and a strengthening dollar all at the same time. If you understand markets at all, you know that any one of those three forces alone is normally enough to push gold lower. All three together should have crushed it. And yet here we are, Friday close, March 13th, 2026, gold at $5,219.30 per ounce. Hold on to that thought, because in about 8 minutes, I am going to show you exactly why the way gold is holding this level tells you something far more important than the price itself. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here, and that is what Currency Insider is built on. Calm, data-first analysis, no hype, no sponsored content, no agenda. Everything I show you today comes from publicly available sources, and I will name every single one as we go. Today you are going to understand exactly why gold holding $5,000 under this specific combination of pressures is structurally significant, not just as a price level, but as a signal about what is driving this market. You are going to understand the two forces currently competing for control of gold's direction and which one has been winning. And you are going to walk away with one specific thing to watch this week that will tell you a great deal about where this goes from here. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Before any of that, last week I told you to watch the $5,000 level on gold as the structural bull-bear line. I said if gold broke through $5,000 and held, that changes the conversation entirely. Gold broke $5,000. And as of Friday's close at $5,119.30, according to USA Gold, it is holding. That call hit. But here is what makes this week genuinely interesting. It held in conditions that should have made it impossible. That is exactly what this video is about. Let me set the scene clearly. Spot gold eased just $6.50 on Friday to close at $5,119.30 per ounce, a modest 0.113% decline according to USA Gold. On the surface, that looks like a quiet day. Underneath it, the forces at work are anything but quiet. The U.S. 10-year Treasury yield moved to 4.27 to 4.28% this week, according to Trading Economics. That represents one of the highest sustained readings since the Iran conflict began. For gold, which pays no yield at all, rising real rates are a structural headwind. Every basis point higher on the 10-year is theoretically another reason to hold a Treasury instead of gold. At the same time, the U.S. dollar index closed at 150 on Friday, according to Yahoo Finance, up 0.3% on the day. A stronger dollar makes dollar-denominated gold more expensive for every buyer outside the United States. And layered on top of both of those headwinds, oil is trading above $100 per barrel. According to Bloomberg, gold was on pace for its second consecutive weekly decline. And the Iran conflict deepened materially this week, with U.S. and Israeli strikes killing Iran's supreme leader, according to CNBC reporting. Now here is what should make you stop and think. Wars normally boost gold sharply. The safe haven bid is supposed to be automatic, but the reaction has been muted, not absent, but muted. That tells you something important about who is actually moving this market right now, and that is what we need to unpack. Drop a comment right now. I want to know, are you currently holding physical gold, a gold ETF, mining stocks, or some combination? And are you in the US or UK? The comment section here becomes a real-time picture of where this community is positioned, and I read every single one. Here is what is actually happening beneath the surface. There are two forces in direct competition for control of gold's price right now, and they are pulling in opposite directions with roughly equal force, which is precisely why gold is consolidating rather than breaking sharply either way. Force 1 is geopolitical risk premium. The Iran conflict is not a contained regional skirmish. U.S. and Israeli strikes killing Iran's supreme leader represent a dramatic escalation, the kind of event that in any normal macro environment would have sent gold rocketing through $5,200 and beyond within hours. The safe haven bid is real. Central banks are not selling. Institutional allocators with genuine risk-off mandates are not reducing gold exposure into this. Force 2 is rate and dollar pressure. The 4.27 to 4.28% 10-year yield is not a theoretical number. It is a live alternative return that institutional money managers compare against gold every single trading day. When you can earn 4.27% on a U.S. government bond with essentially no volatility risk, the opportunity cost of holding gold rises meaningfully. Add a dollar that is firming rather than weakening, and you have a genuine structural headwind. Think of it like two people pulling a rope in opposite directions with almost identical strength. The rope, which is gold's price, barely moves, but the tension in that rope is enormous. And the moment one side gets meaningfully stronger than the other, the rope snaps hard in that direction. That is the setup heading into this weekend. What makes this particularly important for anyone holding gold at home, in a stack, in an ETF, in a pension, or a SIPP, is the weekend gap risk. March 14th and 15 are non-trading days for gold. COMEX is closed. The spot market is closed. If anything material happens at the Strait of Hormuz over the weekend, tanker strikes, Hormuz closure threats, Iranian retaliation, gold will gap at Monday's open. According to Light Finance, key support and resistance levels for March 16th are expected at approximately 4,296 and 5,266 respectively. That is a $270 range. That reflects genuine institutional uncertainty about where Monday prices. If you know someone who has been holding gold through this Iran escalation and trying to make sense of the price action, share this video with them right now. This breakdown took real time to put together, and the people who need it most are probably not searching for it. Now I want to bring in something that I think is being badly underreported in the coverage of gold right now, because most of the commentary is focused entirely on the Iran conflict and missing a deeper structural story. Before the Iran escalation even began, J.P. Morgan had a 2026 gold price target of $6,300 per ounce. Deutsche Bank had $6,000. Both of those targets were published before this conflict began, according to Gold Silver's reporting on institutional forecasts. Think about what that means. The two largest institutional voices in commodity markets had already, based purely on fiscal math, dollar trajectory, and central bank buying, projected gold reaching $6,000 to $6,300 this year. The Iran conflict is not in those models. It is additional. Now, before you run too far with that, institutional price targets are projections over a 12-month horizon, not guarantees, not trading signals, and not invitations to buy at any price. I want to be clear about that. What they do tell you is the direction of institutional thinking about structural gold demand. And that direction has not changed. The World Gold Council's data on central bank reserve buying confirms that central banks globally have been adding to gold reserves at a pace that has no precedent in the modern era. These are not traders reacting to price charts. When a central bank makes a multi-year strategic decision to increase gold reserves, they are making a statement about their long-term confidence in the dollar's reserve status. For UK investors specifically, there is an additional dimension worth understanding. When gold rises in dollar terms while sterling weakens against the dollar, which is exactly what the current DXY trajectory implies, UK gold holders see amplified returns in sterling terms. The Bank of England's own reserve data shows that institutional gold positioning in the UK has followed a similar directional trend to what we are seeing globally. Stop. Before we go any further, I want to be completely honest about the bearish case here, because I would be doing you a disservice if I only told you one side. The muted reaction to the Iran conflict killing Iran's supreme leader is genuinely concerning from a bull perspective. If that event, one of the most geopolitically significant developments in decades, could not push gold above $5,200 and hold it there, that tells you the rate and dollar headwinds are more powerful right now than most bulls want to admit. There is a real scenario where weekend news brings de-escalation signals, ceasefire talks, a humanitarian corridor announcement, any diplomatic movement, and gold gaps sharply lower at Monday's open. DXY rallies to 102 to 103. The 10-year holds above 4.3%. Gold flushes toward the $5,000 support level, and stop-loss selling in leveraged futures positions accelerates the move. That is not a tail risk. That is a legitimate scenario with genuine probability. Here is a question for the more analytical members of this community. Given that gold held $5,000 through a Supreme Leader assassination, a 4.28% yield, and dollar strength, what do you think that level of resilience tells us about the structural floor in this market? Drop your answer below. I genuinely want to know what you think. Let me bring in the broader macro layer because it ties everything together. The Iran conflict is not just a geopolitical event, it is an inflationary event. Oil above $100 per barrel feeds directly into energy costs, transportation costs, manufacturing costs, and ultimately consumer prices. Treasury yields rising nearly 13 basis points for the week amid mounting concerns about an energy-driven inflationary spiral, according to trading economics. That is the bond market pricing in the possibility that the Fed cannot cut rates as quickly as previously hoped because the conflict is reigniting inflationary pressure. The Congressional Budget Office's own fiscal projections were already making the long-term dollar math difficult before any of this. War-related spending adds to that pressure. Now here is the honest framing. I am not saying the dollar collapses. What I am saying is that the combination of a fiscal trajectory that was already strained, an inflationary oil shock from a major conflict, and central banks globally continuing to diversify reserves away from dollar assets, that combination is the structural case for gold at $5,000 and above. De-dollarization is a decade-long process, not a Tuesday event. But the direction of travel is documented and it is not reversing. For UK investors, the LBMA, the London Bullion Market Association, remains the pricing benchmark for European gold markets, and the vault activity data there has been consistent with the broader global trend of physical accumulation rather than distribution. If you have stayed with me this far, what is coming next is the part that ties the whole picture together. The three lanes framework, my one specific call for this week, and an honest look at both directions this market could move from here. All right, let me show you how I am actually thinking about this week using the three lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. Gold futures are consolidating just above $5,100. The key structural level is $5,000. The break and hold above that level is technically significant. Leveraged long positions in gold futures carry real gap risk heading into Monday, given the geopolitical wildcard. Lane 2, the physical market. Physical gold holders have the cleanest risk profile in this environment. No margin calls, no gap exposure, no roll risk. Central bank buying at multi-year elevated pace per World Gold Council data. No evidence of physical distribution at current levels. Lane 3, macro. DXY at 100.50, 10-year yield 4.27 to 4.28%. Oil above $100. Iran conflict actively escalating with Supreme Leader killed. Fed meeting March 18th, GDP revised to 0.7%, rate cut signaling a genuine possibility. In 15 years watching currency and commodity markets, the times I have seen geopolitical risk premium, physical accumulation, and structural fiscal pressure align simultaneously, even with rate headwinds working against them. Those have historically been periods where the path of least resistance for gold was higher over a 3 to 6 month horizon. Not straight up, not without volatility, but higher. I am not making a price prediction. I am describing a historical pattern. When the paper lane is showing tension at a key structural level, the physical lane is showing accumulation, not distribution, and macro is pointing toward both geopolitical risk and fiscal pressure. The historical resolution has tended to favor the physical signal over the rate headwind. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The Federal Reserve meeting on March 18th. Specifically, any language change around the rate cut timeline in the context of revised GDP at 0.7%, and the Iran conflict's inflationary pressure on oil. Here is why this matters so precisely. If the Fed signals that the combination of slowing growth and geopolitical inflationary risk is pulling policy in two directions simultaneously, and that rate cuts could come sooner to support the 0.7% GDP reading, gold loses its single largest structural headwind in one sentence. The 10-year yield drops, the dollar softens, and gold at $5,119 suddenly has considerably less resistance above it. If instead the Fed doubles down on holding rates higher for longer because oil above $100 is reigniting inflation fears, the headwind intensifies and the $5,000 support becomes the critical test. Watch the Fed statement and press conference on March 18th. Watch specifically for any language around the GDP revision and the phrase balanced risks. That is where the real information will be. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Iran escalation over the weekend, Additional Hormuz closure threats or confirmed tanker strikes forces a safe haven surge at Monday's open. Gold gaps above $5,200. The Fed on March 18th signals that rate cuts could come sooner given the 0.7% GDP revision. The dollar softens, gold begins a challenge of the $5,400 resistance level, and the JP Morgan $6,300 target comes back into active conversation. Here is what needs to happen for the cautious picture instead. Weekend news brings de-escalation signals, ceasefire talks, a humanitarian corridor announcement, any diplomatic movement toward resolution. Gold gaps down toward $5,000 support at Monday's open. DXY rallies to 102 to 103. The 10-year holds above 4.3%. Stop-loss selling in leveraged futures positions accelerates the flush. Gold retests $5,000, and whether that level holds becomes the defining question of the next 2 weeks. Both are genuinely possible right now. This is the highest risk weekend gap environment for gold in several months. Both directions carry legitimate probability. Your job is not to pick one scenario and emotionally commit to it. Your job is to watch which conditions are actually developing when markets reopen. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear. And I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, are you holding physical gold right now? And if so, are you comfortable holding through Monday's open given the weekend gap risk, or are you feeling exposed? Second, looking at what we covered today, do you think the Fed on March 18th or the Iran conflict is the bigger driver for gold over the next 30 days? Drop both answers below. The comment section here becomes a real-time picture of where this community stands, and I read every single one. Subscribe because next week we are going straight into the March 18th Fed meeting. I will show you exactly which phrases in the Fed statement move gold and which ones are noise, and that is a skill worth having in any macro environment. And if someone in your life is watching their gold position right now and feeling unsure about what Monday brings, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.